All right, today we're going to pull back the curtain on something that sounds, kind of dry, but is actually one of the most powerful levers a company can pull to shape its own financial story. We're talking about inventory accounting. It's a choice that can totally change a company's reported profits without selling a single extra item. So, how does this hidden profit shifter really work? Let's get into it.
So let's kick things off with a little puzzle. Picture two companies. They are perfect twins. I mean, they sell the exact same stuff, buy from the same suppliers, and have the same number of sales. But when the end-of-year reports come out, one of them shows a much, much bigger profit than the other. How on earth is that possible?
Well, the secret isn't in some brilliant marketing campaign or a new operational strategy. Nope. It's buried deep inside their financial statements, all stemming from a single decision about how they account for the stuff they have sitting in the warehouse.
To really get this, we have to look inside that warehouse and face the one big problem that makes all of this so complicated in the first place. Prices. They just never stay the same.
Think about it like this. Let's say you stock a product. This week, it costs you $10 a unit, but next week, your supplier hikes the price to $12. Now, when a customer buys one, what cost do you put on your books? Did you sell the $10 one or the $12 one? The choice you make right there, well, it changes everything.
And that brings us right to the heart of the matter, this key term, cost of sales, which you'll also hear called cost of goods sold. Basically, this is the number that represents the direct cost of whatever you just sold. And it's simple math. The higher your cost of sales, the lower your profit. And of course, the other way around.
So you see, how a company decides to calculate this cost is not some tiny little detail for the accountants to worry about. Oh no, it's a fundamental decision that directly shapes its profits, its tax bill, and the entire way investors see the company's performance. This whole thing basically comes down to two competing ideas. You could even call them two different stories a company can tell about how its products move from the warehouse to the customer.
And those two stories are called FIFO and LIFO. FIFO stands for first in, first out. It assumes you sell your oldest inventory first. Just think about milk in a grocery store. They always push the older cartons to the front so they sell first, right? Then there's LIFO, last in, first out. This assumes you sell your newest items first. The classic analogy here is a pile of coal. You shovel the coal that was just dumped on top right off first. Now, here is the absolute key. These are just assumptions. They don't have to reflect what's physically happening at all.
Now, while FIFO and LIFO are the main characters in this drama, there are a few other methods out there. But the really big distinction to flag is that LIFO is pretty much a US-only thing. It's allowed under US GAAP, which are the accounting rules there. The rest of the world, which mostly uses international standards, or IFRS, doesn't allow it. And that's a really big deal. Okay, so the theory is interesting, but what does this actually do to the numbers? Let's get to the big reveal and see just how dramatic the impact of these choices can be on the bottom line.
Let's start with a scenario that's a little unusual, but really shows how this works. A situation where prices are falling. Under FIFO, you're assuming you sold the older, more expensive inventory first. That gives you a higher cost of sales and boom, a lower profit. But with LIFO, you're assuming you sold the newer, cheaper stuff. That means a lower cost of sales and, you guessed it, a higher reported gross profit.
But, falling prices aren't exactly the norm in most economies. So what happens when we flip the script to a much more typical situation, where inflation is the name of the game and the cost of everything is constantly going up? Well, as you can probably imagine, the whole dynamic just completely reverses. The advantages and disadvantages switch places, and the financial story the company tells the world gets turned on its head. And this right here is the key takeaway for most situations. When prices are on the rise, FIFO is going to give you a higher reported profit. Why? Because you're matching those older, cheaper costs against your current higher selling prices. LIFO does the complete opposite. It matches your most recent and therefore highest costs against your revenue, which leads to a lower reported profit. So now we see how the math shakes out. But let's bring this back to the real world. Why should anyone, an investor, an analyst, anyone, actually care about what seems like a technical accounting choice? There's a quote from our source material that just nails it. It says, "This choice can result in significantly different amounts for both cost of sales and inventory." And significantly different is putting it mildly. This isn't just a rounding error. It's a major fork in the road.
So let's just quickly break down these real-world consequences when prices are rising. FIFO gives you bigger, happier-looking profits. But LIFO, with its lower profits, can lead to a lower tax bill in the US, and that is a huge reason why companies there use it. On top of that, FIFO makes the inventory on your balance sheet look more valuable because it's priced at more recent costs. And both methods can totally warp the key financial ratios analysts use to judge a company's health.
Let's just take a quick look at one of those ratios, inventory turnover. In simple terms, it's a measure of efficiency. It's supposed to tell you how quickly a company is selling its products and not just letting them gather dust on the shelves. A higher number is usually seen as better.
But here's the trap. Remember our identical twin companies? In a time of rising prices, the company using LIFO will have a higher cost of sales and a lower inventory value on its books. Well, both of those things make the inventory turnover ratio go up. It makes the LIFO company look way more efficient than the FIFO company, even if they are operating exactly the same way. It's basically an illusion created by an accounting choice.
And that brings us right back to where we started. A profit number on a page isn't just a cold, hard fact. It's the end result of a story built on choices and assumptions. So, the most important question isn't just how much money did they make, but rather,
Are they telling the FIFO story with higher profits and more valuable assets? Or are they telling the LIFO story with more conservative profits and maybe some tax benefits? Figuring out which story is being told, well, that's the real key to understanding the numbers behind any business.